It's chaos now. I'm your host, Steve Van Metre, and thanks for joining me today. In our show today, Germany just declared an emergency, and the situation there has gone critical. I'm going to show you what's happening in Germany and why the chaos that's affecting the German economy is rapidly spreading all across the world, and soon will come to American manufacturers as well. Now let's head over to S&P Global, where we picked today's story up with a headline as the German manufacturing sector is now still firmly in contraction territory midway through Q4, and this was not supposed to happen. Remember, this was a lot of election uncertainty here in the U.S. that was going to spread goodwill all across the world, and it wasn't long ago that the experts were saying that the German economy was turning around, and finally the manufacturing base was catching a much needed revival. We said, hold on, it's about to make another big move to the downside, and sure enough, that's exactly what we're seeing. The Germany manufacturing PMI came in at 43 for November, and this is dangerous news because anything under 50 denotes a contraction, and this is above and beyond what happened last month. So what we're seeing in the German manufacturing sector is further contraction, and this is going to mean outright chaos for its economy, as you're about to see. Here we see employment, purchasing activity, and stocks all fall at a faster rate. And it's everything to do with the weak demand and competitive pressures. And that's exactly what happens when demand falls. You start to see an increase in competition as manufacturers try to get as much business from those out there who want it. And that means a shrinking amount of demand is dangerous news because it's going to lead to a disaster for the German economy. And as you're about to see, spread all over Europe and to the rest of the world. And that weak demand led to further decreases in both input costs and output prices. So you think about this, we hear a lot from people who say that inflation in the US is going to see a revival, it's going to surge higher on rising input prices. But what we're seeing in Germany due to weak demand and increasing competition is that input prices are falling. So you see, as manufacturers demand less input goods, what happens? Price tends to fall. That's exactly what we're seeing, and that brings output prices down, the latter falling at one of the quickest rates in over the past 15 years. Business expectations edge higher for the second month running as hope remains strong, because when you're in a downward spiral, the only thing you have is hope, and that's what German manufacturers are hoping for, is that this downward move is over, but it's highly unlikely because what we're seeing is a German manufacturing base is leading the rest of the world to the downside. However, a backdrop of political and economic uncertainty meant confidence was still low by historical standards. The rate of decline in manufacturing production eased to the weakest since June. Nevertheless, it was sharp and slightly quicker than the average recorded over the current sequence of contraction in output that stretches all the way back to May of 2023. And we've noted that we've been in this slow decline, and at some point it was going to get worse, and that's exactly what we're seeing in the German economy. And I want to know from you, weigh in the comments, who do you think is going to be the first country to enter a recession? Is it going to be Germany? Is it going to be China? Who's it going to be? And while you're there, check out the stock for our sponsor of today's show, Kairos Pharma. Again, you can find them on the New York Stock Exchange under the symbol Kappa, that's K-A-P-A, because German manufacturers in turn have cut production. This is something we warned was going to happen as they continue to have difficulty winning new business, meaning there's just less new business to go around. Problem is, there isn't enough new business to go around to support all the manufacturers, so that means there's naturally going to be some losers, and that means output's going to decline, capacity is going to decline. And let's take a look at some U.S. data to see what's going on in Germany and what's coming to the rest of the world and to U.S. manufacturers. As we look at capacity utilization in blue against manufacturers' new orders of durable goods, that in red on a year-over-year rate of change, and what you see is a decline or slowdown in durable goods new orders leads a reduction in capacity at the factory level. And you see that happen here around 1995, again in 1997, and then going into the dot-com bubble starting around 1999. But look what happens starting in late 2005. You see a slowdown occur, but capacity utilization rises, suggesting that there's something wrong until new order growth plunges into the global financial crisis. And along with it, capacity utilization. We see that same thing happen again around 2013, and all of a sudden, as new order growth continues to fall, factory demand catches up with it and plunges. Now we're seeing the two in sync as we look back to late 2021, where we see new order growth slowing and capacity utilization falling. This is a dangerous sign for the U.S. economy as well, because what's happening in Germany is coming to U.S. shores in a not too distant future. There remained a distinct lack of pressure on capacity across the manufacturing sector, as evidenced by a further sharp, albeit slower, drop in backlogs of work. And so what's happening here is there isn't enough new orders to sustain the workforce, so that you take the existing workforce and you put them on your backlogs, and the problem is they've been chewing through backlogs at a very rapid pace. The challenge becomes is when they run out of backlogs and there isn't enough new orders to keep everyone busy, well, that means hours are getting cut. That's the minimum, and jobs are going to go with it. As such, workforces were scaled back for the 17th month running during November. The rate at which factory employment fell was the second quickest since the initial phase of the pandemic in 2020, just behind that recorded in September. So here you can see the second fastest pace since the pandemic. We're seeing German workers lose their jobs. This is dangerous, but something we see has a lot of upside potential. That's the stock for our sponsor of today's show, Kairos Pharma, on the New York Stock Exchange under the symbol Kappa, K-A-P-A. Here you can see that symmetrical triangle forming, suggesting it's a continuation pattern of the upside move. We think that's going to break out to the volume profile line at $2.10, marking a potential 39% move to the upside. Stay tuned to the end of the show for more information. But what this means for the labor market all around the world is that more workers are going to lose their jobs, as we now look at the capacity utilization rate overlaid with the unemployment rate in red. And you can see that these two move together as capacity of a factory user that's utilized declines. Well, that means there's also an equal decline in the workforce, and you can see this near mirror relationship all the way from back in the 1960s. And you look at right now where everyone's saying, no, the unemployment rate's going to come back down. But if you look at capacity utilization, it's coming down. So you cannot get a declining capacity utilization and a declining unemployment rate at the same time. They go hand in hand, suggesting that what's happening in Germany is not only going to affect the entire Eurozone, as you're about to see, but is eventually going to affect American workers as well. Goods producers also made deeper cuts of their purchasing activity and stock levels during the penultimate month of the year. The decrease in post-production inventories was the joint quickest for more than 3 years, while stocks of input fell at one of the fastest rates since 2009. Now you think about this. Why aren't they building inventory here? Well, if prices and demand were rising, well, they would want to build inventory now at a lower price to eventually sell it at a higher price as demand increases. The problem now is they're seeing prices decrease, and they don't want to get stuck with expensive inventory. And again, if you're not building inventory, if you're not clearing through backlogs, and you don't have enough new orders, well, it means you don't need a lot of workers either, and that's exactly what's hitting the factory sector there. Firms reported reducing inventories not only because of decreasing demand and production requirements, but here's a big one, but also to save costs and due to improved material availability, suggesting, as we know, input prices heading down, no need to build inventory. The situation for the German industry is looking pretty grim, as people feeling the pinch, as reports of companies in the manufacturing sector now planning massive job cuts are coming in almost daily. So here you can see the emergency warning flashing over the German economy, potentially making them one of the first to head into an all-out recession, and this is dangerous for the global economy. The PMI employment index backs this up, showing a trend of accelerating staff reductions since mid-2023. So far, this has only slightly impacted the unemployment rate, but makes it even more urgent for the new federal government to take action and boost Germany's competitiveness. New orders aren't dropping as fast as they were in recent months, but that's little consolation when we look at foreign orders alone. Now think of this, that's outside Germany, that would be Asia, that would be the United States. Look at this, the situation has gotten worse. The slight speed up in delivery times also points to weakening demand. And that's spreading across the Eurozone. Let's take a look at what happened in France. As factory orders in France now fall at the fastest rate since May of 2020. And what we're starting to see is there could be mass unemployment in the Eurozone. And if that happens, well, there's no way that Asia is going to get away with this and stay out of recession. Neither will the U.S. But we'll take a look at the U.S. data here in a moment. They note the sharpest drop in manufacturers' new orders since the first wave of COVID-19. Competitive pressures are driving firms to discount. Well, that's exactly what happens when you have increased competition.